Wells Fargo CFO John Shrewsberry. He's also a member of the CNBC Global CFO Council. John, very good afternoon to you. Thanks for joining us.
Thank you. Glad to be here.
I wanted to talk overall first about the revenue, which was essentially flat year over year. Most analysts had expected it to decline slightly. Were you happy with that?
Well, would always rather have more rather than less, but it is nice to beat expectations. It was a complicated quarter for us. We had flat revenue. Our expenses were a little bit higher. We produced $4.6 billion worth of net income. I think what investors were taking away from the report was that happiness that both loans and deposits have been growing year over year and quarter over quarter. We seem to be getting some of our the last of these sales practices issues behind us with our elevated operating loss expense in the quarter. Charlie, as you mentioned, will be starting next week. I think investors are excited about that. And then in interest income, we gave pretty good guidance for this year, and we're sticking with it. And people now are curious about what next year looks like, and we gave some relatively specific guidance for that. And I think it exceeded people's expectations given how low rates have gone over the course of the last quarter or so. And that's why the stock, as you pointed out, seems to be up a little bit today.
Well, to that point, let's talk about the forecast for net interest income going forward, John, because as you pointed to, during the course of the last quarter, we saw yields get incredibly low. And even though we've had a rate cut since then, and we may well have another couple, do you feel like net interest margin has bottomed in terms of the foreseeable future?
Yeah, I don't think that it quite has. We're calling for our net interest income, knowing what we know today about what implied forwards say about the shape of the curve at the front end and at the long end, estimates for loan growth, estimates for deposit growth and deposit costs, that our margin will probably come down a little bit further. It looks like it'll probably flatten over the next couple of quarters. And all in, that combination of events leads to net interest income next year that's probably down low single digits versus 2019, which, again, I think was better than people might have imagined, given the huge rally in rates and the Fed moving in the front end.
John, it looks like you had some good traction in your consumer loan business, and it seems as if other of your banking peers had similar. What does that tell you about the state of the U.S. consumer and where they feel financially they are right now?
The consumer is very strong. So our mortgage business produced about $58 billion worth of originations in the quarter. About 40% of that is refinancing as people are taking advantage of lower rates, which means 60% are people purchasing homes. So I think that means that they feel comfortable with their income, with their ability to service debt. And that's certainly borne out by the numbers over the last 10 years. The household debt-to-income ratios, payment-to-income ratios have gotten better and better. People have gotten less leveraged. So that's good news. In autos, we've grown auto originations year over year more than 40%. We had really slowed our auto originations down for a period of time and then got back into the market in a bigger way this year. People are buying cars, both new and used. And in credit card, we also had an increase of about $800 million in the quarter. That's more seasonal. People tend to spend more and revolve more later in the summer and during back-to-school season. There's nothing particularly different about that. But the performance of our consumer credit portfolios, the three that I mentioned and others, has really never been better. It's very good right now, reflecting a healthy consumer.
What about on the corporate side? Are you seeing confidence slipping because of the trade war?
Yeah, well, I don't know if it's because it's a trade war, but certainly I'm sure it's part of it. But CEO confidence, as reported, has been slipping. Businesses for some period of time have been deferring CapEx. The GDP numbers suggest much lower business fixed investment. That's what's been missing in this in the late part of this recovery in terms of business spending. And I think people are taking a little bit of a risk-off approach. It hasn't yet impacted jobs. That, of course, would have an impact on the consumer if it happened, and the consumer is what's been driving the late stage of this recovery. So, corporate balance sheets are in good shape. Our corporate customers' credit quality is very strong, but they're defending that, I think, by being a little more circumspect about what they spend money on and risks that they take. And the trade rhetoric isn't helping.
John, what do you think Charlie Scharf will do differently and needs to do differently on Monday morning?
You know, it's hard to say. I think he will arrive and begin a thorough investigation of all of our businesses, how we do what we do, things that we've been emphasizing recently. I think he'll bring a fresh perspective to the approaches that we've been taking to both growing our businesses, serving customers, as well as on the regulatory and risk remediation front. So I'm not sure what to expect, except that I can tell already that it will be very thorough, and the conclusions that he reaches and that we all reach together will be borne out by the facts on the ground and by this fresh perspective.
Did the regulators imply to you that you needed a full-time CEO and they wanted to see who that was before they would consider lifting the asset cap?
I don't know that it's that explicit. I think when the board announced after Tim Sloan's retirement that they were appointing Alan as an interim CEO and that they intended to do an external search, that set the table for things as they transpired over the last 6 months. I certainly think it's helpful in any discussion with the regulator to be able to say affirmatively that this is our CEO and it's a permanent position. He is full-time, as you say, and that's got to be a help at the margin.